What are the outlooks for the Japanese yen and for the euro? Both are significantly different, and we detect there's been a major policy change in Japan that probably changes radically the outlook for the yen over the medium term. Now, to understand the background for these currencies, the first thing to do is to put the US dollar in context. And basically we think, certainly through 2018, maybe beyond, capital is leaving the US dollar. This is capital that essentially infused the dollar over the previous 3 to 4 years as money was escaping from Asia and from Europe for various reasons. Xi's anti-corruption drive in China, the excessively easy monetary policy by Draghi in Europe, essentially caused money to go into the US. That money is now leaving in search of economic acceleration elsewhere. But the response of policymakers is radically different, and this is what matters. In the case of Europe, and we include here the euro and sterling and other European currencies, policymakers are allowing the capital flow back into these countries to let their currencies rise. And in other words, the adjustment of capital flows leaving the dollar is a currency adjustment in Europe. In Asia and in emerging markets, it certainly isn't a currency adjustment. Central banks in those countries are trying to monetize the effects of capital flow. In other words, they're preventing the capital inflows from driving currencies higher, and they're allowing their asset markets to rise instead. So to put it this way, the Wall Street bubble is being exported to Asia and to emerging markets. Now, why does Japan matter in this equation? Simply because Japan traditionally has targeted liquidity in its financial markets. Arguably, it's targeted liquidity at too low a level over much of the last 20 years, but it has been targeting liquidity. What it seems to be doing now is targeting the yen exchange rate against a basket of peer currencies across Asia. That targeting of the yen, which has been in place for maybe 15 months, means that the yen is hardly moving on the exchanges. It's broadly stable. So all the adjustment to capital flow is being taken in the asset markets. So in other words, what's the bottom line? The bottom line is three things. Number one, the yen is no longer going to be a strongly trending currency. It will be stable against its peers. Secondly, that Japan will see a liquidity cycle very much like the rest of Asia, more like a roller coaster ride if you like. And thirdly, if they're targeting the exchange rate, not liquidity, it will be virtually impossible for the Bank of Japan to hold the 10-year JGB at 0% yields. Okay? What does it mean for the Eurozone? It basically means that the euro is going to have to adjust upwards significantly. If all the burden of capital flow is being taken on the chin of the euro will overshoot. That is going to have devastating effects for the European economies in 2019-2020. It may throw them back into recession, reopen the debt concerns, the debt problems last seen in 2010, and potentially raise a spectre over the long-term integrity of the euro.